since the end of the past week. The rise of US yields over the past few days may have clipped the potential gains of gold's price, while USD relatively inactivity may have allowed gold's price to advance higher. We expect fundamentals including the Fed's intentions as well as financial data releases such as June's US employment report to influence the precious metals price next week. In this report, we aim to shed light on the catalysts driving gold's price and assess the future outlook. The Fed intentions seem to remain hawkish. It's characteristic that Fed Chair Powell, in his speech at ECB's annual forum in Sintra, Portugal, doubled down on the bank's hawkish stance as he did not exclude the possibility of back-to-back rate hikes, while also stating that, if you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. That tells us that although policy is restrictive, it may not be restrictive enough and it has not been restrictive for long enough. Overall, should the Fed's hawkishness be maintained, we may see the USD gaining further ground and thus waiting on gold's price. On the other hand, we note that better than expected data from the US showed that consumer sentiment for June is more optimistic than expected, while at the same time, the number of new home sales for May was higher than expected, both pointing towards a more robust US economy and an appetite for more spending. At the same time, the acceleration of the US GDP rate for Q1 tended to imply that the possibility of a recession in the US economy may be avoidable. Yet the release which may have characterized the week was on Friday, as the US core and headline PCE rates slowed down, may more than expected, implying that inflation is cooling off and thus weakening the USD, allowing for gold's price to ascend higher. We note Commerzbank analyst comments last Friday that gold demand in China, the largest gold consumer worldwide, seems to have stabilized despite the weak economic recovery, which could be considered a positive for gold's price. On the other hand, it seems that demand in India is easing and investors in physical gold, coins and bars are willing to postpone any purchases awaiting lower prices. At the same time, demand for jewelry seems also to have eased in India's huge gold market. There are still mixed signals from the two Asian countries, and it's characteristic of the lack of direction in the overall gold market in our opinion. In the coming days, we highlight two key events for gold's price. The first is to be the release of the Fed's June meeting minutes tomorrow, Wednesday. The document is expected to be scrutinized by traders and analysts, and should the Fed's aggressiveness be evident, we may see gold's price losing some ground. On Friday, we highlight the release of the US employment report for June. The NFP figure is expected to drop, implying that the ability of the US economy to create new jobs is easing, while the unemployment rate is expected to drop as well, implying that the US employment market is still tight. Lastly, the average earnings growth rate is expected to slow down, a bit in a signal that the US employment market may ease its support for inflationary pressures in the US economy. Overall, a possible disappointment of the markets should be expected. If the NFP figure drops as low as expected or even lower, which in turn may weaken the USD, allowing gold's price to rise. Yet the forecast seems to imply that the US employment market is to remain tight, which may allow the Fed to continue its monetary policy tightening, clipping any potential gains for the precious metal. We highlight that we may encounter increased volatility around the time of the release, hence some caution is advisable. Thank you for watching.